Those 4 secrets and tips will completely change the way you look at your charts and approach your trades. Hello, welcome back, and I've prepared a super special video today. The 4 best tips and secrets for technical analysis and chart reading. And I'm sure this will completely change the way you look at price, you understand price action, and hopefully make a very big impact in your trading. And I want to remind you, please leave a comment, please subscribe to my channel, and also leave a thumbs up underneath my video. It really helps with the YouTube algorithm. And every now and then I make YouTube live sessions. I don't record them. They are only for the people who are subscribed. So if you want to get notified when I do my YouTube live trading webinars, make sure to subscribe as well. And now let's get into the video. So the first one, it's called extendedness. Well, you can call it whatever, but the basic concept of what it is, it means how far away is the price action from a moving average. And this has many different implications of how you can use this concept. There are many ways how you can use that. First of all, the most obvious one is that whenever you see that the price action is very far from your central moving average, it means the price is very overextended. Some people may even say that it is oversold or overbought in this case. And the most obvious use case is that you are trading the price action back to the moving average. And this is especially helpful in Forex trading, because Forex trading is a mean reverting market in contrast to stocks, which is generally considered a trending market. In Forex, it is much more common to see the price fluctuate around a mean. And I use the 50 period moving average in this example. You can use any moving average. You can use a shorter term moving average like the 20. You can use the 100 moving average for a longer term approach. But if you're going for somewhere in the middle, the 50 moving average is a good choice. And what I do in my trading is that I look for scenarios that show me that the price is very overextended. So it's very far away from the moving average. And then I go to a lower time frame and then I try to find patterns and entries, as we will see later, that allows you to trade the price action back to the moving average or very close to the moving average. And you avoid scenarios where the market is just fluctuating around the moving average, because obviously then the profit potential when the price is very close to the moving average is not as high as in situations like that. There are obviously other use cases. I know traders who use the moving average as a trend origin. So you look for moves away from the moving average. In my trading, I never found that this really worked too well. So I specialize in trading the price action back to the moving average. So what I do is I look for situations like in here, where the price action is very overextended. It's very far away from the moving average. It also hasn't been back to the moving average in a long time. That can help as an additional filter. What you want is that you don't only want to see the price away from the moving average, but you also want to see a lot of time between the last touch points between the moving average and the price action. And then you just look for ways to trade it back on the lower time frames, and that works exceptionally well. Here are ways how a trader may use a moving average as a pullback approach. So when the market is in a trending phase, you look for moves away from the moving average, like in here, or even here. Or the other traders, if you use the concept of extendedness, you wait for the price action to get very far away from the moving average. You wait for signals, could be divergences, as we will see later, or other concepts that we will explore as well in this video, and then you just trade it back to the moving average. And if you want to know more about technical analysis, I have a special offer for you. Make sure to check the link in the description below. The first time ever that we are giving away all our 8 trading courses in one bundle, one price, very affordable. Make sure to check that in the link below. The second concept is trend strength and exhaustion, and it works really well together with extendedness. So what we want is that we want to analyze how strong is a trend, and there are many ways how you can estimate the strength of a trend. And one of the best and easy and most obvious ones is the use of the stochastic indicator. Indicators are very, very helpful when it comes to objective trend analysis. Many hedge funds, many big algo firms use them because it's just an objective way to analyze price action. And when it comes to the stochastic, what you want is an oversold market. And contrary to popular belief, when the stochastic is an oversold, it doesn't mean that the price will bounce back. It means that the market is likely to continue because it is very, very, very weak. So the market is in a very strong downtrend, as shown here by the stochastic. And the stochastic, it can remain, and it often will remain, in overbought and oversold for a long, long time during strong trending markets. So what you want is that you want to have a cross of the price action below the moving average, and then you want to see that the stochastic is entering the oversold area, and this is then the signal that you are in a strong trend. And as long as the market is really staying in the oversold area and the stochastic is in the oversold area, you are looking at a very, very strong trend. Here the opposite, the market crossed above the moving average, the stochastic entered the overbought area, and this is where then the trend accelerated and really kept going. And I would really recommend that you get away from this conventional trading wisdom. Well, I'm not even sure you can call it wisdom, but when the market is in, or when the stochastic is in overbought, you don't look for shorts, you look for trend continuation trades. When the stochastic is in oversold, you don't look for buying opportunities, you look for selling opportunities with the trend. That is really, really where it's helpful. Of course, you can, and it is important to know and to understand when the market is turning. So when is this downtrend likely to end? When is this uptrend likely to end? And we can use another method for that. So this is the same chart. I just took off the moving average. And this is still the same area I marked it with oversold in the previous picture. That's the overbought area that we've been looking at. And now I added a RSI. And we want to see an RSI divergence. So when is the price action not agreeing anymore with the indicator? And we have that here. The price action makes lower lows. The indicator is making higher lows. This is a divergence. And it means that the price action is not as strong to the downside anymore. The downtrend is losing momentum. And then shortly after, you can see then the stochastic also left the oversold area and started this uptrend. Shortly after, the stochastic entered the overbought area and the uptrend really accelerated. And then we have the same here at the other side. The price action is showing you higher highs, whereas the RSI is showing you lower highs. Another divergence. It means that the uptrend is losing strength. It's not as strong anymore. And then shortly after, the market collapses. So how you can use that is maybe use the stochastic to analyze trend strength to find very, very strong trends. And then you can add the concept of a divergence with an RSI, for example, to help you understand and help you find situations when the trend is losing momentum. So those really, really nicely complement each other. And here we have another example. So here I use the RSI again, and I have drawn here a center, a level in the 50 period, in the 50 level. And what it does is it separates the RSI in a bullish and in a bearish area. So whenever the RSI is above 40, you are technically in a bull market. When the RSI is below 50, you are in a bear market. I also added a moving average channel to your charts that just help you to visualize the trend a little bit better. And what you want is that you want to get in as close to the market breaking above the moving average and also above the RSI as possible to find new trend following trades. And if we remember and if we remind ourselves of the first concept where we talked about extendedness, when the market is very close to the moving average, that's often where new trends emerge. So this is where we are coming back to this concept here again. So this is more of a trend following approach, whereas if you look for overextended markets and trade it back to the moving average, that would be considered more of a reversal approach. And so what we want is that we want to get in as close to the moving average breakout as possible. We need the RSI as a confirmation. So we want to have the RSI above 50, and then you can use it to stay in your trades as long as the trend is still valid. And you can see that There are many ways how you can do that. You can go to the, like in the previous example with the RSI divergence, you can try to find divergences to get out of your trend following trades. You can wait for the market to dip back into the moving average. You can use the RSI in general. You look for a cross in the RSI below 50 to get out of bullish trades. And then the same thing happens to the downside. You want to get in as close to a bearish or to the moving average breakout as possible. Then for a new bearish trade, you look for a confirmation. Here is the market still in over or not below 50, so you have to wait a little bit longer as a confirmation tool, and then you are in a downtrend as long as the market and as long as the RSI is below 50 and also below the moving average channel. So there are many ways how you can measure trend strength and understand trend strength. So I really would urge you to find what works well for you. Here is another approach. I marked this area here in green. This is the 4-hour time frame, and we will go to a lower time frame and observe this exact period, the green mark period, on the 1-hour lower time frame to get another idea of how you can approach that. And pullback trading is generally considered a very, very good and exact trading approach. So what you want is that as long as the market on the higher time frame is still in the bullish mode, you're looking for bullish entries. And those happen when the market dips back into the moving average channel and also then move away from or cross back above 50. And this happened multiple times. The market moves into the channel, moves away from it, moves into the channel, moves away from it, into the channel, moves away, into the channel, trends higher, into the channel, trades higher, into the channel, it breaks below it, but on the higher time frame, remember we are still in the bullish mode as long as we see this area here. The market is still on the higher time frame in the uptrend, and then when the market came back above the moving average channel, the uptrend accelerated. And this is a very basic but a very effective pullback approach in a trend following market. So you go to the higher time frame, like here, you look for the bullish period, RSI above 50, price action above the channel, and then you go down to the lower time frame and look for pullback entries, for example. And this is something that will help you look at trend strength in a different way. Number 3, deceleration, one of my favorite concepts that I have learned actually from Moritz in our masterclass. And this is really, really helpful. It has completely changed the way I look at charts. And I would encourage all traders to really get the idea of it. And what we are doing for that is we are looking for an established trending market, and then we are looking for candles that show us deceleration. Those are small candles, inside candles, very, very small dojis, could be pin bars as well. But what we want is we want to have small candles that exist after a strong trending market, and then we look for reversals. There are many, or there can be often small candles within the trend, like here or here, and they don't lead to a reversal. Why? We're going to learn in point 4 of this video, but in this point it is first just important to understand and that you start looking for those areas. You have a strong bearish candle, then the market completely dies down, and then you have a strong bullish candle. It shows the reversal, the slow gradual change. To the downside, we have a strong bearish market. This is the largest bearish market in this whole uptrend. And right after this bearish candle, we have 2 doji candles with long wicks. What do they show? They show a temporary pause, a neutral market, and most importantly, they show that the market has lost conviction in the selling pressure in the short side. So it's time to get out of your shorts if you're short, and it's time to go to the lower time frames and look for potential long entries. And whenever you see after a strong move that the market immediately dies down, that is your clue to start looking for trades into the opposite direction, and you can see the market then accelerated away from it. We have it here on the S&P. We saw that just last week actually. The market traded back in this previous support area. It acted as resistance. You can see the market came in very, very strong. And then you have 2, 3 very, very small candles. They show deceleration. The bullish momentum died down, and then you can see this huge bearish drop. And this is how it looks on the lower time frames. This is the big level that came in on the daily time frame. On the lower time frame, now the 1 hour We have a divergence here on the indicator. It shows us here is the momentum losing strength. Here it is completely rolling over. And then you even have a nice pattern here. You have a break and a retest pattern on the lower time frames. So this is how you would use, or how you could use, the deceleration concept with a multi-time frame approach. We have the Aussie Yen, which I traded with some of my students in the master class. The market was rallying very, very strongly into the previous resistance zone. There were two levels on top of each other. The market found resistance at the first one. You can see when we zoom in, there is a strong bullish candle that then got reversed into a small doji candle, a very small bearish candle, and then the acceleration to the downside. This is how it looks when we zoom in. Strong bullish candles now fade and become smaller. This is our deceleration candle. You would go to a lower time frame, look for an entry opportunity. But whenever you see that the market is giving you this deceleration, also very far away from the moving average, so we are in an extended market, that is your clue that something is changing in the market dynamics and that maybe a new trending opportunity is going to present itself. This is how it looks now on a lower time frame. So this is the area on the daily time frame, the deceleration. This is how it looks on the lower time frame. We can draw a very nice trend line in here. We see already that the market is rolling over after the triple top. Here we have lower highs. It breaks the trend line, comes back into the trend line, gives you a retest, builds this flag, breaks out of the flag, and another trend continuation to the downside. Every time it is confirmed by the trend rider histogram. Every breakout is also signaled and confirmed by a red trend rider. And this is how you can put the pieces together in your puzzle with the price action. And again, the 8 trading courses, I listed them here actually for you. We have advanced price action strategies. We have supply and demand strategies, trading as a business course, which is also mental and psychology course. We have day trading strategies. We have stock trading strategies. We have a Forex for beginner course. When you're starting just out, you can just brush up on your basics, get an understanding of what Forex is, and then you can dive into the advanced strategies like price action, supply and demand, or day trading strategies. You also get instant access to over dozens of special webinars, hundreds of hours of webinar recordings, and the link in the description below. You have instant access to everything here once you enroll. So this is a one-time chance for you to bring your trading to the next level and have your whole Forex education in one place. Let's get to the last key point and the last point which brings everything together really, and it is called, or I called it, key level. And instead of taking trades at random places all over your charts, you let the price action come to you, and you only take signals and trades at key levels. As we've seen in the last point where we talked about deceleration, very, very often you'll see in a trend that a trend temporarily pauses, and you have small deceleration candles that don't lead to anything. And this is very normal. This is normal market behavior, normal market structure. So you have to filter out those areas. And the best way to filter out trades that don't go anywhere or just situations that don't trigger is to only trade signals at important key levels. So here we are on the daily chart, and I was watching this downtrend here for a long, long time. There were many situations where the trend actually slowed down, but it didn't happen anywhere where it made sense. Only here did the reversal and did the deceleration make actual sense, because it happened at a previous support or resistance area that turns into support. And also, this is a demand area which started this huge uptrend. So it does make a lot of sense to have a deceleration here. It makes much, much more sense than to have a deceleration here, which happens in the middle of nowhere. So this is the best approach that you can use to filter out trading opportunities that are not as high probability, and you will let the price come to you. Here, another example, you have a nicely defined range with a bottom and a top, and you wait for deceleration at key levels. Here is a very good support level. The market came back into the support level. A strong bearish candle leads to a deceleration candle, which shows you the end of the trend. Here you would then go, after this doji, you go lower to maybe to the 1 hour or to the 4 hour time frame, and you look to time your trades, which is what we do in the masterclass. Here you have then the market is coming back into the previous resistance level. It is rallying very, very strongly, strong bullish candle, and then it leads to a deceleration candle and is a huge new downtrend. And this is very, very important. It's such a simple filter. It seems very simple, but it can completely change the way you look at charts. Here again, you draw your levels at previous resistance levels, turning points. You wait for the price to get there, and then you wait for the market to show you a deceleration candle. So whenever you see a complete market shift, strong bullish candle turns immediately into a deceleration neutral candle, that should show you that something is really changing in the market dynamics. The buyers are not strong anymore, and maybe the sellers are ready to take over. And then after this doji, you just go to the lower time frame and you look for patterns or other ways to time your trades. Here we have another example. You could use moving average to look for deceleration as well. So when the market shoots back into the moving average, that is where you look for deceleration candles, or you just let the market come back to the previous resistance. And this is really how you can use those 4 secrets. They integrate very nicely together. You can see how key levels and deceleration work together. You can see how overextendedness work together. So whenever you see a deceleration at a level that is very far or happening very far from the moving average, you just trade it back to the moving average, or you bet on a move away from the moving average. So you wait for the market to get back to the moving average and then trade it away from the moving average. And those are all key points that will help you improve your technical analysis skills, your price action, and your understanding for charts. Let me know if you like those types of videos. If that is interesting for you, make sure to check the link in the description for the masterclass and all the courses that we offer. And I look forward to hearing from you. I read every single comment. Even if I can't reply to everyone, I am reading every single comment and I use it as inspiration for my next videos and also for my podcast. Thank you for watching, and until the next time.